Hi there, everyone, and welcome to this week's market update. Don't forget that any advice contained within this presentation is general only, so it is tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Okay, so the XJO today closed a little bit lower, nowhere near as low as what we were expecting considering what we saw in the US last night. Now, technically, guys, you can see our market is sort of holding up towards the top of the range here. A lot of our indicators are starting to back off a little bit, so they're not quite as overbought as they were across the top of this range here in resistance, as I was testing resistance. But nonetheless, guys, look, we're very resilient compared to what we're seeing overseas. We're seeing big movements down in China, we're seeing big movements down in the US, but we're holding up very close to our all-time highs. And the all-time high for our market is up here at 76.25. So, yeah, we're definitely a favored market in this environment. I'll talk to that a little bit more in a moment after I cover the technicals. But look, technically at this point, guys, it's all about this support level here. I'm probably thinking we could drift a little bit lower depending on how much strain we see in the commodities and the oil market over the next few sessions. The reason why we saw a bit of red on the screen today, I believe, was really led by some weak iron ore futures that we saw yesterday. Those iron ore futures picked back up, hence a little bit of a kick up this afternoon, but also a reasonable move down in crude over the last week. And I'll talk to the reasons to that in a moment. But nonetheless, look, 74.50 there or thereabouts is that level of support. If that clears through, then the 200-day moving average and a clear support level at 73.44 seems to be lining up as a strong target. So look, it's just really a waiting game. We've been pretty much sideways since the top of this move through here. You can definitely see that short-term trend has now ended. But the problem we've got right now, okay, with the fact that that's ended, we're kind of in no man's land, right? If I scroll out, there's no nice trend to follow right now. Through the COVID era, eventually we had a fairly good uptrend line through here that we're following through that whole period of time, which created some pretty good trading opportunities. That you can clearly see that trend has now changed to sideways. At one point, it was downtrending or close to downtrending, but overall now we're kind of in a bit of a channel once more, and that channel range is really near the all-time high where we've just tested recently, and likelihood the bottom of it will be 72, but in the same breath, guys, look, even though this is now it's channeling, it's a changing beast, right? What could be happening is a start of a new trend, and we could see a pullback or a lot of sideways back down near 72, and then this could be the start of a new trend. It's really too early to tell. I think we're really at that pivot point phase, or we're in that sort of in between phase where we're trying to establish what the exact trend is. For me, I'm just treating it as sideways right now. We've ended that trend, that short term movement up. That's finished off. We're now near key levels of resistance, treating it as a channel, guys, okay, and that, bringing out those type of sort of channeling type strategies that we use in the options side of the market, because strictly just buying stock and holding right now in the short term is not good trading, guys. Trading directional right now is a little bit on the difficult side as well. So what we're really leaning on is those option strategies, those short iron condors, the bear calls out of the money, the bull puts out of the money, whilst this market continues to whip around sideways. As we know, sideways movements can last weeks, months, years, right? I think I've seen good 8 month sideways periods before, where the market stays in a 400 point band, right? It's not great directional trading, guys. All right, so S&P 500, a little bit different over in the US at the moment. So they're back below their 200-day moving average. They've pulled back at roughly 4% from their highs, maybe call it 5% from their March highs, okay? And they're still quite a bit off their all-time high over here. Looking a bit oversold, but nonetheless, still got a bit of downward momentum playing out. So look, the S&P 500 definitely has a lot more downward movement than what our market has at the moment. Going across to the Nasdaq, you can see the Nasdaq's down roughly 8% from the March highs. Okay, so you can see there 8.2% from those March highs. Whilst we're still hovering very close to our March highs and our all-time high And yeah, so you can definitely see a massive disconnect between our market and the US market in the short term. One of the sort of bigger reasons to this is the fact that our market is a heavily minor agricultural export market, value stocks listed on our market, less so growth stocks. And in this environment of raising interest rates, value stocks definitely outperform growth. Also, to say, guys, you've got elevated commodity prices across the board, which also helps our mining industry. And a big part of our market is miners, guys, right? There's no debating that. So, our market is probably set to outperform a little bit in the short term here as we see this inflation story play out. But technically, at this stage, US markets still look a little bit bearish, but starting to get into that oversold sort of area. So there might not be much selling left in the short term. That's really going to be determined by how things play out over the next few sessions. There's a lot going on this week, guys, and I'm about to talk about here. All right, so the first things first is inflation, guys. Obviously, that is the driver of interest rates and what people think is going to happen next to the economy. So, to sort of put it lightly, you've got to be keeping an eye on energy pricing right now. So, crude, natural gas, and gas prices throughout Europe are the main things I'm looking on the energy side. Even coal's elevated at the moment. So, energy across the board is high, it's inflated, and but I'll say, but it's not as bad as what people were first indicating on the back of this whole Russia-Ukraine conflict. So on the back of this conflict, I remember was it February when this all started? Might have been late February when this all started. Um, Everyone was spruiking crude oil up to $180 US a barrel. It hasn't happened, guys, right? Will it happen? I doubt it. Okay. Do I think there's some upward movements in oil left? It could be. Depends on a lot of things happening in the background right now. The biggest thing that people missed here was the fact, what people weren't expecting was that China, India, and a few other countries are still buying Russian oil. Okay, so despite being cut out of the world monetary system, despite all the other sanctions and things that's happened out there, China is buying oil from Russia, as is India, which means Russian supply is still coming onto the world market. Right? There's no debating that. It is what it is. And that's one of the reasons why crude didn't jump as high as what many people were expecting. What this also should translate to eventually is that inflation may not be as bad for as long as what some people were expecting. And this may mean the Fed eventually may not have to act as severely as what they're indicating right now. We'll soon find out. But this is the story to watch. You need to watch agricultural prices, which have been elevated highly at the moment. So, just look up your agricultural futures, your wheat, your corn, your oats, that sort of stuff. Then also your energy side of things. Those two areas, if they start pulling back and normalizing again, then that's going to take the pressure off interest rates. Then you're going to see the dynamic change back again to people going towards growth stocks and maybe away from value, or value will growth will start outperforming value in the short term if that mood changes. So that's the dynamic to watch out for, guys. There's a dynamic, there's a theme right now. The theme is, oh no, we've got runaway inflation in the US. Interest rates must have to come up. That's what the rhetoric is. And what we're seeing is buying in the value space on the back of that. The other thing that's driving crude oil down at the moment is Chinese lockdowns. I think they're going to play out, or people are thinking they're going to play out longer than first thought. When I first heard of the lockdowns in Shanghai, it was going to be a 2-week strict lockdown, and that was it. It sounds like it's going to be a bit more than just that, where parts of the city are going to be locked down and other parts won't, depending on how many cases and things like that. And that's what we heard today. So crude came back up a little bit today after that news. Okay, so crude got dumped over the weekend on the back of the Chinese lockdown riots and things like that, but crude's crept back up again today. So there's a dynamic shift there as well on the on the demand side of oil. Okay, so the whole supply side with Russia, Ukraine, OPEC, the US, obviously using their strategic reserves as well. We got petrol prices coming down locally because of the excise being removed. So, there's a lot at play here, guys. There's a lot on the demand side, and there's a lot on the supply side of oil that's playing out around the world. So it's not all about Russia, Ukraine, okay? It's also what's happening with China lockdowns. Is it going to get worse? Can they get COVID under control? Are they going to back away from their COVID zero policies that they're running at the moment? So there's a lot playing out in China that we have to watch out for, in the sense of what's going to come next in oil prices and that demand side of oil. And that also leads on to what is potentially going to happen on the inflation side as well. Okay, so tonight we have US CPI. Many are expecting upwards of 8%. Okay, big number, will be the biggest reading since early 80s. Look, at this stage, there's no doubt it's going to come in as a high reading. What the market does from there on, okay, is the big thing here, right? So I'm actually not too sure. I think the market somewhat has priced this in. They've sold down into this reading, and we could easily see a move in the other direction. I'm not sure, to be honest, guys. Okay. At this point of time, let's just wait and see what happens and see how that wants to play out. The other thing we're going to see this week is US company reporting. Okay. So that kicks off Wednesday night with JP Morgan. That's the one I'm watching out for. I want to see how those US banks are going, because that could definitely see some of our banks move here as well, depending. Especially Macquarie Bank, that moves quite a very similar model to the US bank model. So we've got to keep an eye on Macquarie Bank on Wednesday. So that'd be Thursday morning for us. Thursday morning at the same time, we'll see Bank of Queensland report. So we're going to get a hint on how the banks are going. We'll see a local bank report, we'll see a US bank report, and maybe that's going to give us a little bit of a hint on what's going to come when some of our banks report early May. All right, so there's a lot of reporting this month, guys, from the US. There's a lot of operational quarterly reviews as well for our miners and our energy sectors. So plenty of data this week, plenty of news that we've got to keep an eye on. So just on talking about CPI, inflation, interest rates, things like that, we're not going to hear from the RBA or the Fed until early next month. Okay, so we've pretty much cleared through everything that we need to clear through from a central bank point of view. What do we know, okay, from a central bank point of view? Well, we know that expectations are the Fed will raise rates by 0.5% next month, and they will continue to raise by 0.5% the month after. We're also expecting in the May meeting to hear more about the runoff of their balance sheet. So they're going to start selling assets onto the market. Okay. So May is going to be a big one, I believe, early May, in the sense of hearing from the Fed. The other one's the RBA, where a lot of people are now predicting the RBA is going to start lifting rates around June. I think that's going to be heavily dependent on how local CPI comes in. If local CPI comes in under control, I can't see them doing a whole lot, guys. I do think they should raise rates a few times this year, but don't think they're going to raise as heavily as what's being indicated on the bond market at the moment. Obviously, depending on how things play out, in the sense of energy pricing. I think the move from the government to drop the excise on petrol is going to go a long way to help the inflation situation here locally. So let's see how that plays out, guys. There's a lot of unknowns coming for us this year, and we're just going to have to trade as we see those unknowns come to light. Last but not least, another reason for our market to disconnect from overseas is this is an election year for us. So what we're going to see is the 21st of May next month. So we're talking about 6 weeks from now. We're going to go for a federal election. At this point of time, from a market point of view, I can't see any each way. I can't see Liberal or Labor being anything negative for the markets. It's not like it was last election, where Labor came on wanting to abolish the franking credits and abolish the negative gearing. That did get markets a little bit, squeamish. But what we're seeing is a little bit of eagerness of spending, right? I think both parties are really not talking too much about balanced budget in the short term. which is what the market wants to hear. The market wants to hear that the government's going to spend money. And I think both sides are sort of talking that way. So I think from a market point of view, if anything, it might be a little bit of upward momentum on the back of the election here. Uh, each way, I don't really care who gets in from a market perspective. I think both will be sort of here or there. I don't think it's going to be a big influencer. But overall, you do get some excitement sometimes out of these elections. So let's keep an eye on the polls. Let's keep an eye on the movements in the market and see whether there's going to be any real effect there. Okay. All right. So not much else to say here, guys. There's just a lot to play out this week yet before we get a really good view on things again. I want to see what the CPI rating looks like tonight, and then we're going to kick off another reporting season in the US, which is, I think, quite an important reporting season this year, just to see how some of these companies are faring given the supply chain issues that we're seeing, the costs going up. So we're seeing corporate bonds all going up across the board. We've got petrol prices, we've got energy prices going up. It's getting more and more expensive to conduct business. It's going to be interesting to see what businesses are starting to see that effect and what and which companies are not. All right, so that's where we're at, guys. Okay, I'm going to leave it there. It's a bit of a long-winded video, so thanks for listening in. Take care, and bye for now.